Hi, this is Jeffrey Shank, a chartered financial consultant and the host of the Talk Money Show. I've been helping my clients for more than 30 years, and now I'm going to help you. Join us to learn about the financial issues that concern you the most. You'll hear from the experts on a range of topics, get some great ideas, and it's all designed to help you make more out of your money. So tune in to Talk Money right here on Eagle News Radio.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Incorporated, a registered broker-dealer, member FINRA SIPC. Investment advisor representative, Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Financial planning services through Andover Advisory Group, a registered investment advisor. Cambridge and Andover Advisory Group are not affiliated. Cambridge does not offer tax or legal advice.
Good morning, Justin. I want to thank you for your hard work. The information is a big help, and I appreciate what you did.
Enjoy the show.
All right. Thank you.
Okay, that's great to know. Thank you for the information.
You're very welcome.
Okay, Jeff.
Okay.
Thank you very much.
You're very welcome.
You're right on the money, Jeff. How are you doing this morning?
Thank you.
Well, those are good questions. Hopefully that helps.
Yes, thank you so much.
You're very welcome. You're going to hear stuff here that you don't hear anywhere else on radio.
And don't forget it.
I'm Jeffrey Shank, and this is Talk Money. Hey, welcome to the show. Thanks for joining me today. And a little bit about me. I am a chartered financial consultant, the founder and owner of Andover Advisory Group, a registered investment advisor. And for almost 30 years, I have been providing effective financial advice for individuals and small business owners. This show today is the third in a series on the basics of financial planning. Good morning, Lou. How are you this morning?
Good morning. Looking forward to continuing the series.
Yes, yeah. And this today, what we're going to do is we're going to talk about something that really sits at the center of financial independence: smart saving and investing principles. Our focus today is not just on saving more, which is important, obviously, but on growing your wealth responsibly and efficiently, using tools and strategies that are available to you right now. So let's get right into it. Let's start with the foundation, tax-advantaged accounts. So the key idea here is it's not just about how much you earn, it's about how much you keep. So the government actually gives us powerful incentives to save through accounts like 401ks, IRAs, HSAs, health savings accounts. These accounts allow you to legally reduce your tax burden, either now or in the future. Another major benefit is compound growth without interruption. What do we mean by interruption? Being interrupted by a tax on the growth, right? Yeah. That's what we mean. So when your investments are taxed every year, your money does compound faster, sometimes dramatically faster. And finally, think of these accounts as a toolkit, not just a single option. Each one has a different purpose, and when you use them together strategically, you can create a much more efficient system for building long-term wealth. So let's break down how these tax advantages actually work. There are 3 layers of tax benefits. First, you can reduce your taxable income today. Contributions to things like a traditional 401k or an IRA, if you qualify for the tax deduction, will lower your current tax bill immediately. Second, you get, as we mentioned before, tax-deferred growth. That means your investments grow year after year without being taxed along the way. And third, in some cases, you get tax-free withdrawals. The best of all worlds, right?
Yeah.
Roth IRAs can work for you that way, and HSAs, health savings accounts, can work that way as well. And there's something really powerful. HSAs combine all 3 benefits at once. That's why they're often called the only account with a true triple tax advantage. What do we mean? HSAs, you put the money in, it goes in pre-tax, so you're not taxed on the amount of the contributions that you make. It grows tax deferred. And when you pull it out for a qualified expense, medical expense, you don't have to pay taxes on the withdrawal. And you do have to incur that expense in the tax year
Right.
that you make the withdrawal. Keep that in mind. It's not something you can't like accumulate those and then 1 year say, oh, all those expenses I paid for the last 3 years, I want to get reimbursed for them. It doesn't work that way.
No.
All right. And again, we're just going to touch on the basics here. We're not going to get into the detail of each one of these necessarily. So let's zoom in though on the main accounts that you'll be working with. First, your 401k or workplace plan. You can contribute a significant amount each year. Many employers offer matching contributions, which is essentially free money. In fact, if you don't sign up, in many cases, you're not eligible for any contributions from your employer. So you're effectively leaving money, compensation for your work on the table. And you often get the choice between a pre-tax contribution, that's a traditional 401k contribution, and the Roth contribution, which is a after-tax contribution. Which one's best for you? I'm often asked that question. It depends.
It depends.
It depends. So next, IRAs. A traditional IRA, so this stands for Individual Retirement Account, actually created back in the 70s for self-employed individuals, and then eventually expanded to everybody in the 80s. A traditional IRA gives you tax deductions now and tax deferred growth. And I should just mention here, the tax deduction is available, but subject to qualification.
Okay.
All right. So depending on your income, and depending on whether or not you're covered by like a 401k plan at work, that determines whether or not you can actually take the tax deduction for an IRA contribution. A Roth IRA flips that. You contribute after tax, but then the withdrawals, when you take the money out, those are completely tax-free. And then, as we mentioned before, we've got the HSA, Health Savings Account. This account is incredibly powerful because of its triple tax advantage. It does require a specific type of health plan. Keep that in mind, what they call a high deductible health insurance plan. So if this is through your company, you have to ask your employer whether or not this is a high deductible health insurance plan that would make you eligible to contribute to an HSA. And importantly, the funds roll over indefinitely. So there's an alternative to the HSA, which was they call an FSA, flexible spending account. With the flexible spending account, you make contributions during the course of the year pre-tax, and then you use the money that's in that account to pay for eligible medical expenses, deductibles, co-pays, that sort of thing, out-of-pocket expenses. But you have to use it. And if you don't, within a certain period of time, basically a year, you do lose, you forfeit any balances in that account. So you have to manage that very carefully. The HSA doesn't do that. It rolls over indefinitely. If you never use it, it continues to grow, and then you can use the money later on in life, even in retirement.
If you're on Medicare, are you eligible for HSA?
You are not.
Yeah.
That's a great question.
Yeah.
No, you are not.
Not a high deductible?
Well, I apologize. I should say you're not eligible to contribute once you are covered by Medicare. That's what that was your question, right?
Yes.
That was a Medicare question. Yes. So once you're covered by Medicare, you can't make contributions to an HSA. So it doesn't matter if it's high deductible or not.
Right.
Right. It's just you're not
Just
eligible.
can't do it.
Can't do it. Exactly. Yeah.
But if you have an HSA, it sounded like if you have an HSA account open, that balance is still available.
That balance is still available, and there are restrictions on what you can do with that money once you're over 65. But it's still a good plan. You can actually just use it and supplement your retirement if you want to.
Okay.
Yeah.
Yep.
It makes the HSA a strong tool even for retirement healthcare planning, right?
Yep.
And I think, I could be wrong, don't quote me on this, but I think you can use it to pay for your Medicare premiums. I'm not sure. So we'll have to circle back and ask that question. Think of these accounts really, again, as I said before, as a toolkit, right? Each one plays a specific role in your overall financial plan and savings plan. So now you know a little bit about the tools. The next question is, what order should you use them?
It depends.
Yes, but I'd say that generally speaking, the optimized sequence would be step one, contribute to your 401k
Yep.
at least up to the employer matching minimum, right? So the employer says, I'm going to match your contribution up to 6% of your salary.
Yep.
Typically how that works is that the first 3%, first 4% is matched dollar for dollar, and the next 2% is matched 50 cents on a dollar.
Okay.
So you want to put away at least 6% so you can get the maximum matching contribution.
Take the free money and the compound interest that it will generate.
Right, exactly.
Yeah.
And so really that first step, if you have a 401k available to you, it's non-negotiable. It really, it's a
Yeah.
guaranteed return because of the match.
Right.
Right. And what I was going to say is that you could go with the pre-tax or the after-tax. In either case, the company is still going to match your contribution.
Right.
Keep in mind, though, that the company's match is going to be a pre-tax contribution. It
Okay.
has to go into that pre-tax account, cannot go into the Roth account.
All right.
All right. I mean, later on, you can always move that money around if you want to pay taxes on it. Step two, max out your HSA if you're eligible. If you're not eligible, obviously, you can skip this. You
Mhm.
can skip step two,
Yeah.
right? Because the tax benefits here are unmatched. Step three, and then, by the way, there's a maximum amount you can put into into an HSA. It depends on whether or not you're single or married, have a family. Step three, fund your Roth IRA for the long term, tax-free growth. Now, I said that there's limitations, income limitations, or your income will limit your ability to make pre-tax contributions to an individual retirement account. Whether or not you're covered by a plan at work will also determine whether or not you can make that pre-tax contribution. But anybody that has earnings can put into an IRA. The question is whether or not into an individual, regular, traditional IRA. The question is whether or not it becomes a tax deduction.
Yep.
Keep that in mind. Okay. The Roth IRA is a little bit different. With the Roth IRA, it doesn't matter if you have a plan at work. The key here is your eligibility to put money into a Roth IRA at all.
Okay.
So once you reach a certain limit, single or married, you cannot make contributions
Income
to
limit.
an income. Right.
Yeah.
Exactly.
Yeah.
There's an income. Right. So if your adjusted gross income reaches a certain level, you're unable to make a contribution to a Roth IRA. There is a range where you can make a partial contribution and then it phases out.
Yeah.
And you can't make a contribution at all. That's for a Roth IRA, individual retirement account, Roth version. If you're making contributions, a lot of people get this confused. If you're eligible to make Roth contributions to your 401k plan, there is no income limitation. You
Okay.
can make $1 million a year. You can still make a Roth contribution. So let's go back. We said step one, contribute up to the employer's match, right?
Right.
Let's say that you can afford to put more, and the rules let you, because there is a limit on how much you can put in, depending on your age. If you're over age 50, you can make catch-up contributions. If you're 63 to 65, you can make additional catch-up contributions. So as long as the amount that you're putting in to the 401k between pre-tax contributions and after-tax contributions, as long as that does not exceed the maximum, you can make those Roth contributions up to that total maximum limit.
Okay.
So if you can't make a contribution to a Roth IRA, then maybe look at your 401k plan and make Roth contributions there. Okay.
All right. Yep.
And then step four, again, go back, and maximize your 401k contributions, right? So, and what happened to step 3? I don't know. I skipped step 3, fund your Roth IRA. Oh, that
Fund
was
your Roth
right.
IRA.
It was your Roth IRA, right? Exactly.
Just talked about that. Jim.
Yeah, we did. Yes. Right. So you look at step 3, you're looking at your Roth IRA. You're saying, okay, I can make a contribution, max that out if you can. If you can't, then you go back and maximize your 401k contributions. That is just I think a good way to think about your employer plans and the IRA plans that you have available to you.
Mhm.
Okay. Anything else you have extra that to save or part of your savings goal? Put that into a taxable brokerage account. So that sequence prioritizes the tax efficiency at each and every step.
Right.
The idea is simple. Don't leave tax advantages on the table. Don't leave that matching contribution on the table before you move on to less efficient options. What are the less efficient options? Those that as your money grows, you have to pay the taxes on it. All right. So this slide visualizes that same idea as a hierarchy or a ladder. At the base, you have your core savings, 401k match. Above that, your tax advantage accounts like your HSA and Roth IRA. At the top, your additional growth layer, maxing out your 401k and then investing in a taxable account. Each level, again, represents a completed optimization. The key rule here is don't skip any steps.
Mm-hmm.
Each rung offers a better tax advantage than the one above it, so moving in order ensures you're being as efficient as you possibly can. And up to this point, we talked about where to invest. We're going to shift gears here and talk about how to invest. So there's 2 principles to keep in mind that anchor any sound investment strategy. They are diversification and asset allocation.
Okay.
No matter how advanced your strategy becomes, these 2 ideas are fundamental. If you get these right, chances are you're going to be ahead of most other investors. So we're going to get into the details, but one thing I want to mention about asset allocation is that studies have been done repeatedly on the value or the different types of investment decisions that you can make and how it affects overall performance of your portfolio. And over and over and over, asset allocation is the one that makes the biggest difference. Generally speaking, 80% or more of the differences in returns between one portfolio and another can be traced right back to the asset allocation decision. But we're going to start with diversification. Okay. So you've probably heard the phrase, don't put all your eggs in one basket.
Yeah.
Investing, diversification, that means spreading your money across different asset classes, industries, and regions. Why? Because no single investment performs well all the time.
Yeah.
So if tech stocks decline, if tech stocks decline, that's a big question. Will tech stocks ever decline? If tech stocks decline, other areas like bonds or international stocks might hold steady or even increase. The goal is stability. The idea that your overall portfolio performs more consistently than any one piece on its own. A well-diversified portfolio might include U.S. stocks, international equities, bonds, real estate investments. That balance helps smooth out volatility over the time. And when we talk about risk in an investment portfolio, we're really talking about volatility. The amount that the value of your portfolio moves over a period of time. The more the bigger the swings, the more risk in your overall portfolio. And by the way, you have to understand your personal your personal sensitivity to those swings in portfolio value, right?
Yep.
Because it's important that once you create a strategy, you stick to that strategy. And if your portfolio is not operating in a way that you can handle, right, you might end up making some changes to that portfolio that later on you might regret. So it's very important to match your asset allocation, the volatility of your portfolio, the risk in your portfolio, to that which you can handle and are willing to stick with, a strategy and an asset allocation that you're willing to stick with in good times and bad.
So you don't make an emotional mistake along the way.
Yeah, exactly.
Yeah.
All right. So moving on here. So let's talk about asset allocation. This is how you decide what percentage of your portfolio goes into stocks, bonds, and even cash. The key drivers here are, as I mentioned before, your tolerance for risk and time horizon. If you're younger and investing for the long term, generally speaking, you can afford a higher allocation to stocks, which are obviously more volatile. There's more risk if you own stocks than if you own bonds or even cash. But they come with more growth potential, right? If you're closer to retirement, the focus could shift toward preserving capital and generating stability. So you'll generally hold more bonds and cash as you get closer to retirement or while you're in retirement. And one important point here, your allocation should evolve over time. So it's not static. So you don't pick an asset allocation and just stay with that until you decide to pull a trigger and retire.
Right.
It probably should evolve as you get closer to the time where you're going to be tapping into that money. Okay.
The rule of 100.
Yes, although I don't like to use rule of thumb.
Yeah.
It's something that when I say evolve, it does. I wouldn't base it strictly on age. I would base it on a lot of things, including how your tolerance for risk has evolved. If your tolerance for risk has declined, then you probably want to be rearranging, reallocating your investments.
It's more sophisticated than the rule of 100, but.
Well, here's the thing. Yes, it is. And the other thing that I want to mention is that perhaps just because of your circumstances, or maybe because of your education, level of education, experience, you start to feel more emboldened with regard to risk, right? And so your risk tolerance could increase in the future. And again, your portfolio should match it, because if your risk tolerance has increased and your portfolio is not performing because it's too conservative, then again, might make some changes at the wrong time. So you want to match your risk tolerance with your asset allocation. And so this just says that if you're close to retirement, the focus can shift toward preserving capital and generating stability. Generally speaking, you'd be more in bonds and cash than you would be in equities. But one important point here, again, this isn't a set it and forget it decision. You should revisit and rebalance periodically as your life changes. And that would, I think, requires at least an annual review of your overall investment structure. So wrapping things up here, there's 4 key actions you can take right away. First, take action today. At a minimum, make sure you're capturing your full 401k employer match. If you're listening to this and you don't know, stop, pause the video and go to your 401k.
Go find out.
And go find out. Don't even continue this video. Okay. Secondly, educate yourself. Understand how each account, HSA, IRA, if you're eligible, obviously, IRA, Roth, fits into your own personal situation. Third, start to build your plan. Create a diversified portfolio with an asset allocation that matches your goals and risk tolerance. And fourth, stay consistent. This is the most important part. Regular contributions, periodic rebalancing over time. That's what leads to meaningful, life-changing results. Remember, wealth building isn't about timing the market. It's about time in the market, discipline, and smart structure. And one thing I do want to mention, and because there's a lot of folks that do this, you get an app and you can start trading, in between, at lunchtime.
At lunchtime.
At lunchtime, right? Be very careful with that. make sure that make sure that those actions that you're taking fit into an overall plan.
Have a plan, right?
Okay. Maybe you say, sort of like gambling, and I don't think of investing as gambling, but if you're a regular gambler and you're good at what you're doing and you are disciplined, you have an amount of money that you say, I'm going to gamble with, and once that's gone, I'm done. Right? You don't put the credit card into the into the cash machine, right? So the same thing holds true if you want to do some trading, right? So you get a tip from somebody, or you get an app that they send you these notices, and this one's trending, that stock's trending, this one's trending. Oh, look at this company's just went public, and maybe you should buy into this. I don't have a problem with that. I think it's a learning tool.
Yep.
And you know what? You could make some money with it, but have a set amount that you're willing to invest with, and don't exceed that. Put the rest of the money in a well thought out, asset diversified portfolio that matches your risk tolerance in terms of its asset allocation, and then play with that. Play with the other money. Maybe not a bad term. Maybe a bad term calling it playing, but and don't exceed that. And
learn.
And
use it to learn.
And learn from it. Right. Exactly.
But having accounts that you have to go the extra step to actually make a change and give that extra thought to it is often important, rather than sitting on an app and just making an instant decision.
That's true too.
Yeah.
Right. That's true too. And you want to do your homework. You really do want to do your homework. I mean, if you just on a whim buy something, make sure it's not going to break the bank. But I would recommend that if you have a hunch, do a little research before you actually make the investment, regardless of how much, even if it's only $20.
Yeah.
Okay. Seriously, even if it's a small amount of money,
learn the correct skill set.
Yeah, exactly.
Right?
Yeah. And I would say that this is an area where, hey, we at the Andover Advisor Group, we can help. So you may not want to do this on your own. We can help you develop an asset allocation strategy, give you some help with setting up your accounts and making investment decisions. We will work with you as much or as little as you need to help you to make good financial decisions. So feel free to reach out. Always good to have that third party, that second opinion, looking at things, and
someone who knows what they're doing.
Maybe gives you some insight. I don't automatically assume that people don't know what they're doing, but you don't know what you don't know.
Right.
Yeah. All right. So that's the third in our financial planning series. We got more to talk about, and I think the next one is also on investing, and we get a little bit deeper into the investment planning decisions. So we do have we do have an Ask Jeff question, but we're going to take a quick break, and we're going to come back to that.
Whether you're saving money for your children's education, preparing for retirement, or deciding on the right life insurance plan, you can count on the professionals at Andover Advisory Group. Established in 1996, our company is responsible for providing financial planning services to individuals seeking sound financial advice. We create a comprehensive financial plan that serves as a framework for organizing the pieces of your financial life so that you can focus on your goals and understand what it takes to reach them. And a financial plan can help you prioritize. For example, how saving for college might impact your ability to save for your retirement. Having a clear perspective will allow you to pick the right strategies and confidently choose suitable products and services. Best of all, you'll have the peace of mind that comes from knowing that your financial life is on track. Call us at 978-691-5005 to book your free initial consultation. That's 978-691-5005.
Okay, this is our Ask Jeff question. If you didn't know, I'm Jeff. I get these questions different questions all the time, and some I can't just answer right away. Some I have to actually research and get back to clients and help them to make good decisions. And it's so complex. Getting, I gotta tell you,
And
handling
volatile, it changes. Everything changes.
handling your finances today is just it is so complex. So many different things to think about, and making a mistake, it can be costly. So you want to think things out. But I got this question. So I have health insurance through the Obamacare marketplace.
It still exists.
They call it Obamacare, right?
Okay.
Still the
Yeah.
Affordable Health Care Act.
Yes. The big beautiful healthcare act.
Well, no, it hasn't changed. It hasn't really
No.
changed. I think there was some enhancements to the tax credits during COVID that got I think eliminated. Tax credits or the subsidies for Obamacare, they got eliminated with the last bill. But generally speaking, it's still the plan that was created under the Obama administration, right? And it's through the marketplace. So this is an individual, doesn't have health insurance through an employer, isn't eligible for Medicare. They have to buy individual health insurance coverage, and they're buying it through the marketplace. In Massachusetts, they call that Mass Health. I'm sorry, the Health Connector. I apologize. They call that the Health Connector.
Yeah.
Right. Yeah. So because I have limited income, I pay a very small monthly premium. Do I need to sign up for Medicare when I turn 65 this year?
Interesting.
The Part B premium is much higher. He spelled that wrong. Than what I pay now. I was told that my plan is considered creditable. Creditable? Did I say that right?
What does that mean?
So if you don't sign up for Medicare Part A and Part B when you're first eligible, age 65, and you sign up later, there's a premium penalty applied for signing up late.
Okay.
And so if you have creditable coverage, I think I said it right that time. If you have creditable coverage, then you can avoid the penalty. So as long as you have coverage during that time period where you don't sign up, right? Then, so this person says, hey, I'm going to have this coverage. It's through the marketplace. I don't have to sign up for Part A and Part B. And by the way, I'm getting subsidies, tax credits and subsidies that make that premium very low and much less than what I pay for Part B under Medicare, right? So here's the problem. If you have coverage through a marketplace plan, you probably should sign up for Medicare when you turn 65, because now that you qualify for Medicare coverage, your marketplace coverage will not you will not get the tax credits that you were receiving before you became eligible for Medicare. Okay, the tax credits will end when your Medicare Part A coverage begins.
Okay.
Right.
Yep.
So people with Medicare are not eligible for these tax credits, and the premium tax credit can only be used for the purchase of marketplace coverage. So if you choose to enroll in Medicare Part A and keep your marketplace coverage, you'll have to pay the full price for your marketplace plan, and Medicare becomes the primary payer. If you're receiving financial assistance for your marketplace coverage prior to signing up for Medicare, you're going to get a letter in the mail from the marketplace plan informing you that you are no longer eligible to receive the financial assistance since you are enrolled in Medicare Part A. So you should contact your marketplace plan to make sure that your financial assistance is stopped when your Medicare coverage begins, because if you continue to get those credits at the end of the year, April 15th, when you file your income tax return, you're going to find out that you're not eligible for those tax credits, and now you're going to have to pay them.
You're on the hook.
Yeah, you're going to have to pay them. You're going to have to pay them back. So, bottom line is, once you reach age 65, best thing to do is to stop. Just convert. Just move to move to Medicare Part A and Part B, even though it's more costly than the marketplace.
Another well thought out
plan.
aspect of the plan.
Yeah, exactly. Yeah. So, So those are the kinds of questions that we get, and if you have a question that you'd like us to address here on the show, feel free to reach out, call the toll-free number, or send me an email. It's jeff@talkmoneyradio.com. Be glad to answer those questions for you. We've got more questions in the bag to answer, but we'll do that on another show. So stay tuned. In the meantime, please remember, good sound advice is much better than advice that just sounds good. Thanks, Lou.
Hi, this is Jeffrey Shank, a chartered financial consultant and the host of the Talk Money Show. I've been helping my clients for more than 30 years, and now I'm going to help you. Join us to learn about the financial issues that concern you the most. You'll hear from the experts on a range of topics, get some great ideas, and it's all designed to help you make more out of your money. So tune in to Talk Money right here on Eagle News Radio.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Incorporated, a registered broker-dealer, member FINRA SIPC. Investment advisor representative, Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Financial planning services through Andover Advisory Group, a registered investment advisor. Cambridge and Andover Advisory Group are not affiliated. Cambridge does not offer tax or legal advice.
Good morning, Justin. I want to thank you for your hard work. The information is a big help, and I appreciate what you did.
Enjoy the show.
All right. Thank you.
Okay, that's great to know. Thank you for the information.
You're very welcome.
Okay, Jeff.
Okay.
Thank you very much.
You're very welcome.
You're right on the money there, Jeff. How are you doing this morning? Thank you.
Well, those are good questions. Hopefully that helps.
Yes, thank you so much.
You're very welcome. You're going to hear stuff here that you don't hear anywhere else on radio.
And you don't forget it.
I'm Jeffrey Shank, and this is Talk Money. Welcome to the show. Thanks for joining me today. A little bit about me. I am a chartered financial consultant, owner and founder of Andover Advisory Group, a registered investment advisor. And for almost 30 years now, I have offered effective financial advice to individuals and small business owners. And this is, we're doing a series in fundamental basic financial planning.
Great.
This is the fourth. This is the fourth, I think, Lou, in the series. And it's not to confuse it. It's part 2 of the Smart Savings and Investment Principles. So it's the fourth in the series, but part 2 of Smart Savings and Investment Principles. So if you didn't see part 1, right? If you didn't see Smart Savings and Investment Principles part 1, you probably should stop. Yep. And go back into the library and pull up the third installment.
Binge the series.
Yes, yeah, because we talk about some things here, sort of like a prerequisite, right? You really should watch that one first before you get into this one, because we're probably going to make some references to some of that other stuff. It's not critical, okay? But you don't have to do that if you don't want
Severance.
to.
You have to watch the earlier episodes.
I am not a. I do not watch that one.
Okay.
Should I?
Yes.
Oh no, Severance is the. Oh no, that's the one about the Modern Office where. Yes.
Yeah.
Oh yes. Oh, you absolutely.
You can't just jump in.
You can't jump in.
Nope.
You have to. You're absolutely right. Yep. Yes. I was thinking. What was I thinking of? Some other show, but you're absolutely right. Yeah. I love that. I love that series.
Yeah.
So in the second part of smart savings and investment principles, what we're going to do is we're going to move beyond the basics of saving and start talking about how wealth is actually built over time. Today, we're focusing on three big ideas: dollar cost averaging, behavioral finance, which is really about how our emotions affect our decisions, and the difference between accumulating wealth and speculating. So these are the principles that separate consistent long-term investors from people who are constantly reacting to the market. So let's start with a mindset shift. Successful investing isn't about predicting what the market will do next. Nobody has done that consistently over time. Instead, it's about building a system that works regardless of what the market does. How about that? What a concept, huh?
Yeah.
So there's three key ideas here. First, discipline beats prediction. The people who win long-term are the ones who keep showing up and investing consistently, not the ones making bold guesses. Second, emotions matter. You know, I think we could probably compare these ideas to baseball and right hit it right. Yeah. So discipline beats prediction. People who win long term are the ones who keep showing up and investing consistently, sort of like the hitter that's swinging for the fences. Right. Who do you want leading off your lineup, right? You want somebody who's going to be consistent, who's going to get on base, right? Not trying to hit a home run every time he or she gets up to bat, right? Second, emotions matter a lot. In fact, emotional decisions are one of the biggest reasons people lose money. And third, accumulation beats speculation. Slow, steady investing that compounds over time is far more reliable than chasing short-term wins. That's the foundation for everything else that we're going to be talking about. So one of the simplest and most powerful strategies is dollar cost averaging. I can give you a lot of examples. We're going to talk about this generally speaking today. Maybe on a future installment, we'll get into this in more detail. But what it means is investing the same amount of money on a regular schedule, whether the market is up or down. So here's how it works. If you're investing $500 a month, let's say, when prices are lower, what happens? If you're investing consistently, $500 a month, and prices go down of the investment that you're, the security that you're buying, that you're purchasing, right? What happens? You naturally buy more shares.
Right.
And when prices are higher, what do? Automatically, you buy fewer shares, right? So when the price is up, you buy less. When the price is down, what do? You buy more.
Right.
Sounds like a good strategy.
With the same money, right?
With the same, right, exactly. So instead of trying to guess the perfect time to invest, you let consistency do the work for you. It's simple, it's automatic, and it removes a lot of stress from the process. Now, you might be wondering, how does dollar cost averaging compare to investing everything at once? Historically, lump sum investing actually performs better most of the time. So I have to say that, right? Roughly 70% of long-term, generally speaking, 70% of the time over the long term. But there's a catch. Lump sum requires two things most people don't have: a large amount of cash to invest and the emotional confidence to invest it all at once. So that's where dollar cost averaging shines. The real advantage of dollar cost averaging isn't that it beats lump sum, because over long time periods, it doesn't, right? It's that it helps you avoid the pressure of trying to time the market.
Right.
And for most people, the best strategy is the one they can actually stick with. Consistency beats perfection. This idea is worth emphasizing. A steady automated investment approach turns market drops into opportunities instead of something to fear. Instead of panicking when prices fall, you're actually buying more at a discount. That shift in perspective is and can be powerful. Over time, consistency smooths out the ups and downs and keeps you moving forward, even when the market feels uncertain. So let's talk about what really gets in people's way: behavior. Even the best strategy fails if emotions take over.
Mhm.
This is where we talk about behavioral finance. There are 3 common traps. First, panic selling. When markets drop, people get scared, and what do? Sell.
Yep.
What does that result in? Locking in your losses.
Mhm.
And then, quite possibly, miss the recovery. Second, procrastination. Waiting for the right time often means never getting started and missing valuable compounding time. And third, what we call analysis paralysis.
Mhm.
Overthinking every decision leads to inaction. The perfect moment may never come. So these patterns are incredibly common, and they quietly destroy long-term wealth. So discipline, it really is your greatest asset. The solution to all of this. Dollar cost averaging works because it removes decision making entirely. You're not guessing, you're not reacting, you're just following a system. A helpful way to think about it is like your weekly gas budget. You don't wait for the perfect gas price, right?
Mm.
When you fill up, when you need to? No. When prices are lower, you get more for your money. Investing works the same way. When you zoom out and focus on, let me just go back here before I finish my thought here, okay? Because I did say that you don't necessarily look at the gas price on a regular basis and fill up when the price goes
that was
down.
going to pass.
Okay, I just want to give. Generally speaking, you fill up at the price because your tank is
Yes,
empty,
exactly. Yeah.
right? But obviously, there are times where, especially with gas prices rising, I think I mentioned to you I went to New York, right?
Yeah.
So left my car in Connecticut, took the train in, right? And so there for almost a week, and then got back in the car, had plenty of gas to get home. I got home and I was looking at the gas prices, and it had changed in just a matter of days
Oh yeah.
by almost 20 cents a gallon.
Yeah.
I was shocked. But anyway,
So the last couple of days.
yeah. So if you're watching this, this session in 2028, and I'm talking about high gas prices, you're probably saying, what are you talking about? I'm paying less than $2 a gallon today.
No,
Anyway,
not
So-
not at this moment.
not at this moment, right? So bottom line is, investing, you don't necessarily want to try to time the market. That's the lesson here,
Yeah.
right? You don't want to try to time the market, but if the market does crash someday, that might actually be a good time to make a decision to invest more than you normally had been.
When there's blood in the streets.
So, Lou, that's a old Wall Street saying. When the best time to invest is when there's blood in the streets.
Yeah.
Especially when it's your blood.
I didn't know the back half of that.
Yes. Yeah. So when you zoom out and focus on years and decades instead of just daily movements, the importance of consistency becomes clear, right? It's not about being clever. It's about being consistent.
But the point about when the asset is down and you're buying more shares of it, you're multiplying your gains when it recovers.
That's right.
Yeah.
Exactly right.
Yeah.
Yeah. So let's draw an important distinction here: accumulation versus speculation. Accumulation is about steadily building wealth over time. It's consistent investing in diversified assets, letting compounding do the heavy lifting. Your time horizon is long, years or decades. The process is predictable. Speculation, on the other hand, is trying to profit from short-term movements. It involves timing trades, chasing trends, often relying as much on luck as skill. Now, speculation isn't inherently bad, but it shouldn't replace your foundation, as we talked about in the last session.
Mhm.
Think of it like you're gambling, and you have a budget, an amount of
Yeah.
money that you're willing to risk
Right.
and lose totally. So if you want to speculate, have a budget for have a piece of your portfolio that, hey, this is the amount of money that I'm willing to speculate because I'm willing to lose it all.
Right.
Because that could happen when
Yep.
you're speculating. Absolutely could happen. And for the bulk of the money that you're going to need for short-term and long-term goals, eventually retirement, you want that. You don't want to be speculating with that money, right? The key here is to keep them separate. Build your wealth through accumulation first. If you choose to speculate, do it in a controlled and limited way. So this slide really captures the differences in lifestyle, right? The accumulation investor sleeps well because they trust their process. The speculator is consistently checking prices. I think that slide is, I think there's something missing in that slide, unfortunately. My bad. Reacting to news. Did I do something wrong there? Yeah. Anyway, you don't want to be reacting to news, feeling the emotional highs and lows. Ultimately, it's not just about returns. It's about your relationship with money and your peace of mind. So the question is, which path do you want to follow? And let's kind of wrap this up with a simple action plan. All right. First, automate your investments. Set up recurring contributions so you don't have to rely on willpower. That's one key. If you're going to do this, you're going to take advantage of dollar cost averaging. So I want to point out that if you have a 401k plan through your employer, and you are you're making deferrals through that plan from your paycheck, well, that is a form of dollar cost averaging.
Yes.
So you already have that. If you have a 401k plan, you already have that in place, and it's not a bad idea to max that out. But take as much as you can from that from your paycheck and put it away. Pay yourself first.
Right.
I'm asked constantly, what's the right amount to be putting into my 401k? And everybody tells me it's 10%. Or it's 12%. My recommendation to my clients is put as much as you can until it hurts.
Yeah.
And when you start to feel the pain, put a little bit more in and see how much you can you can tolerate, and whatever that number is. And what am I talking about? I mean, when you get that net deposit into your bank account from your check,
right?
Is it enough to pay all the bills? And if it is, and you still have some left over, and you see your bank account is starting to grow, put a little more into and forget about the percentages. Should you be doing 10%? Yeah, absolutely. Should you be doing 20%? If you could, that'd be great.
Yeah.
But put as much as you can until it hurts, right? Secondly, recognize emotional reactions for what they are.
The pain fades over time too.
It does.
Yeah.
You get used to it.
You get used to it.
Yeah, you get used to your net.
You actually get
net
encouraged
paycheck
by it.
as you see your money start to grow.
Yeah.
Absolutely. Yeah. Recognize that emotional reactions for what they really are, and design your system of saving and investing to avoid them. Third, focus on the accumulation. Build your foundation before taking on extra risk. And finally, take action today.
Yep.
Because when it comes to investing, starting sooner is one of the biggest advantages you can have. So you don't need to be perfect. You just need to be consistent. So that's how wealth is built responsibly. And again, if there's you need some help getting started on this, or you need some advice, or you're not sure how your 401k should be allocated because nobody's there to help you. I don't know. A lot of people don't realize that your employer does not want to give you investment advice.
Nope.
The administrator of the plan does not want to give you investment advice. You're pretty much on your own when it comes to this sort of thing. We actually have tools that can help you to make those investment decisions. So if you want some help in that area, feel free to reach out. Call the toll-free number, leave a message, send me an email, jeff@talkmoneyradio.com. I'd be glad to help you out, answer your questions. And so this we're going to continue on this with this series in the future. So stay tuned for some more. I do have, though, before we finish up this episode, Lou, I do have an Ask Jeff question, but let's take a quick break, and then we'll be right back.
Whether you're saving money for your children's education, preparing for retirement, or deciding on the right life insurance plan, you can count on the professionals at Andover Advisory Group. Established in 1996, our company is responsible for providing financial planning services to individuals seeking sound financial advice. We create a comprehensive financial plan that serves as a framework for organizing the pieces of your financial life so that you can focus on your goals and understand what it takes to reach them. And a financial plan can help you prioritize. For example, how saving for college might impact your ability to save for your retirement. Having a clear perspective will allow you to pick the right strategies and confidently choose suitable products and services. Best of all, you'll have the peace of mind that comes from knowing that your financial life is on track. Call us at 978-691-5005 to book your free initial consultation. That's 978-691-5005.
Hi there. This is our Ask Jeff question. And if you didn't know, I'm Jeff. So the question is, I'm negotiating with a dealer to buy a new car.
Oh,
They offered gap insurance. It covers me if the amount of the loan balance is greater than what I would get if I totaled the car in an accident. Is this a good idea? So here's the thing, right? If you finance a new car with little or no down payment over a long period of time, the value of the car can quickly depreciate as much as 20% within the first year. Well,
yeah.
Potentially leaving you with a large gap in the amount that you owe and the value of the car. So if you total the vehicle, as this person did, or was thinking about, I'm sorry, not did, but thinking about, in an accident, or it's stolen, right? The standard auto insurance policy is going to pay you what they call ACV, actual cash value,
Okay.
right? So that's not what you paid for the car.
Right. Not what you owe.
Okay. Not what you owe. It's whatever the car is worth today, right? So it's the value depreciated over time. And minus your deductible too, right? So gap insurance covers the remaining, saving you from paying out of pocket for a vehicle you no longer have. Here's the thing. Most major auto insurance in Massachusetts, that's where this person is from, offer gap coverage as an optional, affordable endorsement to your standard policy. Did you know that?
No.
Yeah. You have to carry both collision and comprehensive in order to put it on there, but it is very inexpensive. The dealership, in this particular case, or finance company, also is trying to get you to buy the gap insurance, right? But generally
Whose
speaking,
prices are higher?
yeah, take a guess.
Yeah.
Take a guess. Yeah. So if you buy it through the dealer as a separate standalone plan, or you add it on to the financing arrangement, it's probably going to be a lot more expensive. So I would ask them how much it costs. Don't and you know, sometimes you buy the car, you negotiate the price, and then they send you over to the general manager or the specialist, the financing specialist, right? And next thing you know, you're buying extended warranties and
Yep.
and they're
Your
financing.
chassis sprayed. And,
Yeah, do they do that anymore?
I don't know.
Yeah. So ask the question about gap insurance. Don't assume it's not on there just because they didn't talk about it, because sometimes they just automatically put it on there. And yeah, right. And if you already have it on your policy, or you had it on your policy, your auto insurance policy, you don't want to have to pay for it twice, because guess what? It's not going to pay twice.
No.
Yeah. So yeah. So be careful and look at your auto insurance policy as an alternative to the dealer or the financing company's plan.
And it must be cheap because they never mention it. So it must be cheap. Very reasonable.
Yeah. So that's definitely something that you want to take a look at, especially if you're. I mean, a lot of people, they just don't. They finance the entire cost, over a 7-year period, and there's just no way that the vehicle is going to be worth in 2 years what the loan balance is going to be on the vehicle, unfortunately. So it doesn't pay if you unless you have a total loss. Bottom line,
Yep.
not going to pay. The gap insurance is only going to pay if you have a total loss, and you have that, and you're underwater on the
Considerable
loan.
savings, though.
Yes. Yeah. All right. So that's it for this week's Ask Jeff question. We've got more in the future, so stay tuned. In the meantime, please remember, good sound advice is much better than advice that just sounds good. Thanks, Lou.